Good day, folks. And today we'll be talking about trends, where we'll take a deep dive into consolidation, expansion, retracement, and reversals. So, what are trends? A trend is the overall direction of a market or an asset price. Trends are identified by trend lines, but it's actually really obvious. If price keeps making higher highs without making lower lows, that's an uptrend. And if price keep making lower lows without making higher highs, keep making lower lows without making higher highs, or they make lower lows and then they make lower highs, then that's an example of a downtrend. So uptrend. An uptrend is marked by an overall increase in price. Nothing moves straight up for long. It's not that you should just be saying the market just having increase in price for years or every day of the week, every week of the month, every month of the year for years that you just keep seeing that price is up. There are always the oscillations where you see price go lower, price can move sideways, but the overall direction needs to be higher in order for it to be considered an uptrend. So within that price leg, from the point at which that price leg starts to the terminus of that price leg, at the terminus there must be higher prices. And if you look at different price leg within a trend, if there is higher highs for swing highs, if each swing high, the new swing high is higher than the previous or prior swing high, then that's an uptrend. And also goes for the swing lows. If the recent or the new swing low is higher than the prior swing high, then that's an uptrend. And also for downtrends, the downtrend describes market movement towards a lower price from its previous state. So it will exist as long as there is continuation of lower highs and lower lows in the chart. Lower highs and lower lows, where the recent high and the recent lows are lower than the prior highs and the prior lows, respectively. That's downtrend. What you are currently seeing here is a typical example of an uptrend. I'm not saying this is how everything is going to be. Every uptrend you see, this is how it's going to be. But this is just like a gimmick. It's just like a pictorial representation of how it moves. An uptrend, we keep seeing each high in prices higher than the last, each swing high higher than the last, and price keep gravitating upwards. For a downtrend now, we keep seeing price gravitating lower, we keep seeing lower lows and lower highs in this price swing, and price keep gravitating downwards. The starting point and the terminus is lower than the starting point. So that is a typical example of a downtrend. Consolidation. Consolidation is a period when the price moves sideways within a range. It's at this moment where there is no particular trend, there is no uptrend, there is no downtrend. It's just weak. Price is just stuck within a particular trading range. So it illustrates the lack of a trend in a particular trading range. It is the range at which smart money build up positions. If smart money is anticipating price either going up or down, they build up their positions either going up or going down. That buys or sells. Sell position during the consolidation stage. It occurs before the expansion events. Most, if not all, expansion event occurs after the consolidation stage. So after smart money has built up the other things, price moves out in the direction, and then they profit from those move higher. It is used in engineering liquidity at either or both ends of the market. Consolidation stage can be used in engineering liquidity, both buy side, that's the liquidity above the current price, and then sell side, liquidity below the current price. So you can use it in creating or engineering liquidity at either end. They can engineer liquidity at one end and not the other end, or they engineer liquidity at both the buy side and the sell side position. So they can use that to engineer liquidity then. And it may be used to continue an existing trend or reverse an existing trend. We can have a period after an expansion event where price goes into consolidation and then price expands out again. Or we can have a moment where we have an expansion event, price goes into a little bit of consolidation, and then there's a reversal in the trend. So it can be used to continue an existing trend or reverse an existing trend. What you are currently seeing is an example of a consolidation event where price is just within their range. Most consolidation events are priced like this in a rectangular form. It should just be within this particular range. So price is like haphazard, there's no clear trend. And then if you look at it very well, you can see that from this picture they engineered liquidity at both ends of the market. There's buy side liquidity, there's sell side liquidity. It has been engineered at both ends of the market. And then they can run from either side or both sides. Maybe target one side first and then use a Judas swing and go for the other and expand in the other direction. So, but this is a typical example of a consolidation event. Price expansion. Expansion typically occurs when market conditions suddenly change, leading to a quick and substantial movement in price. So after the consolidation event, price will just be volatile. Price will go with displacement. You might go with huge displacement, very big displacement in the direction, in either direction, in either direction, the direction where price is aiming for. So it can go with like a volatile displacement to the sell side or to the buy side. So that's what some people term as breakouts, price expansion, breakouts, breakout from consolidation zone. So this can be caused by either economic news in the sense that there are some news that can come in and then really lead to price volatility. For example, the FOMC news, the NFP news, the CPI, most especially the CPI, that sometimes you just see more a unidirectional price flow. Most times you just see unidirectional price flow. If the price is targeting buy side, they will all go for the buy side. If the price is going for sell side, they will go for the sell side. Unidirectional. So it can also be geopolitical events around the world, maybe wars or maybe terrorism, things like that can also affect price and cause price expansion. And also it can also be due to alterations in market sentiment. Alteration in market sentiment, maybe at some particular, maybe it's due to seasonal tendencies you might have at this particular range, maybe markets goes up. That's the sentiment. Market should go up, and so people will put their money in to buy. Or maybe due to this particular thing that happened, event that happened, okay, we should start seeing higher prices. Or due to this particular reason, we should start seeing higher prices. Or let's say currencies that run concurrently, like the gold and the like the pounds and the euro. Sorry, the pounds and the euro, foreign currencies that run concurrently. That most of the time, if the if the pound is going up, the euro will also be going up. So in those ones, if we have like a lower price, if we have been seeing like let's say downtrend and then the euro start going up, we might also be seeing the same thing most times happening to the pounds. So now the impact of expansion, it can occur in either direction of price. So this is where you shouldn't gamble because expansion might just, the market might expand in either direction. It can expand and go for sell side and it can expand and go for buy side. Significant losses can occur if you are caught upside. There are some markets that there will be like phase of consolidation zone. It occurs a lot in the futures market. A stage of consolidation zone and then 9:30 open, New York time open, 9:30 a.m. New York local time open, and then expansion will occur. There will just be this crazy volatile movement in price, and if you are caught offside, you get smoked. If you are caught offside and you are not using stops, you get smoked. And also during economic news, price might be moving lethargically, and then the economic news is released, and then you just see that volatility. And if it's unidirectional, you are caught offside, you might incur significant losses. Because let's say for the NFP now, even you using your stops, the volatility will make you even lose more than where you place your stop if you are caught offside. So next one, it may signify the beginning of the trend. Yes, the expansion event may signify the beginning of the trend, where the market expands then with some other characteristics. Let's say the retracement and more expansions. It may signify the beginning of the trend. It may also be a short-term retracement of a long-term price movement. So there are some instances that okay, on the long-term price is going down, then there's a consolidation event on the short term, and then price goes up, expands upwards. So it might just be a retracement event, a short-term retracement, or a retracement event, and then from that retracement, price will keep going down. So after the expansion, then there may be a reversal and price will keep going down more. So like I've said it before, it occurs after consolidation stage. So this is a typical example of an expansion event. This is an expansion to the downside. Looking at it, we saw price move from the consolidation zone and then expand towards the sell side, and then target the sell side, take it out and keep it going down with velocity displacement. So this is a typical example of expansion to the downside. And looking at this other one, this is a typical example of expansion to the upside. Yeah, after price has consolidation, the consolidated, then there's like velocity, and then with displacement, they span into the upside. So this is a typical example of price expansion into the upside. Retracements. Retracements are temporary price reversals that take place within a larger trend. Retracements are short-term periods of movement against a trend, followed by a return to the previous trend. So, in part, it can be used to sweep internal range liquidity, whereby price retrace takes out the internal range liquidity. When we get to that topic, you're going to know about that. Internal range liquidity, where price comes down, takes internal range liquidity, and then moves away and then continues the trend. It can be used to offer fair value. And a place where there is liquidity gaps or liquidity voids, price can retrace to those areas and offer fair value in terms of, yeah, especially for fair value gaps. When we get there, we are going to talk about it. Fair value gaps where there will just be accumulation of buys, where the algorithm will just pull buys. For example, in a fair value gap where the algorithm just pulls buys, that's a PC. Where the algorithm just pulls buys. So a retracement can fall into that fair value gap to like balance it, to offer price, to offer sell prices there before continuing the trade. Or in a case where the algorithm just pulls sells, that's the CB. If you ever look at where the algorithm just pulls sells, that's the CB. So the retracement can occur to offer buy prices before the trend continues. And it can be used by smart money to accumulate more positions. So smart money can accumulate more positions if the trend hasn't yet completed its objective or hasn't yet reached the terminus. So any retracement, they can put in more positions. They can use retracement for that. So in the shaded area, this is a typical example of a retracement leg. You can see that after the consolidation, we had an expansion to the downside, and then price retraced upward towards the buy side. Expansion to the downside, and then price retraced upwards. So this is a typical example of a retracement leg. And also, this is another typical example of a retracement leg after price expands upwards. After the consolidation, price expands to the buy side and price expands upwards. We can see the retracement leg, that's the shaded portion, going down. So this is a typical example of a retracement leg. Reversal. A reversal is when the direction of the price trend has changed from going up to going down, or vice versa. Reversals typically refer to large price changes where the trend changes direction. So, for example, we might be having an uptrend, and then that means in an uptrend, we are defined it where we are making higher highs and higher lows, and then suddenly we start making lower lows, lower highs. That's a reversal of that uptrend, and vice versa. So, impact of reversal, the same way with the expansion event, significant losses can be incurred if you are caught offside, and it may signify the beginning of a new trend. Reversal can signify the terminus of an uptrend and the beginning of a downtrend, and vice versa. And it can also be the terminus of a downtrend and the beginning of an uptrend. So reversal can signify that. And this is a typical example of a reversal leg. We saw that after price consolidated, price expanded downwards. Price expanded downwards to the sell side, and then below that. And the next price leg was a reversal leg, clearing out the whole expansion leg. That is how reversal operates. Each expansion leg, for a reversal must clear out the whole expansion leg for it to become a reversal. That's the difference between a reversal and also a retracement. A retracement clears out parts of the expansion leg, but a reversal leg clears out the whole expansion leg. So that's the difference between the retracement and the reversal. And this is the reversal to the upside. And also looking at this is a typical example of a reversal to the downside. After the consolidation event, price expanded upwards to the buy side and above that, and the next price leg was a leg that cleared out the whole expansion leg. It's cleared out the whole expansion leg. So this is a price leg. This is a reversal price leg. It's a reversal to the downside. So this is a typical example of a reversal to the downside. And I'll be showing you more examples where I'll be using the charts, because this is not what you'll be working on when you go to the charts. This is not how you'll be seeing it. So I'll be showing you examples of each of this. Okay. This is a mini NASDAQ chart. This is a 1 hour chart, and what you are currently seeing here, I'll be taking you through the uptrend, the downtrend, the consolidation, the expansion, the retracement, and the reversal. This particular range, this particular price move up is a typical example of an uptrend. The typical example of an uptrend. So we see price gravitates, expand out of this particular range, and then price keep forming higher lows and higher highs. This particular point, if we pick this point, then pick the next point to be this, then pick the next point to be this, you see that each particular point that I'm picking out, you see that price forms each particular point, the previous one to it. For this particular one, the previous one to it, price forms a higher high. The price level at this point is higher than the price level here. Same thing, the price level at this point is higher than the price level here. The price level at this point is higher than the price level here. And the price level at this point is higher than the price level here. So this is a classical example of an uptrend. From the start, where price was 20,132 and up, to, let's say, the terminal. If this is the terminus, then this is 21,262 and up. So price increased. That's an uptrend. And then going by that, we also have an example of a downtrend here, where from the start point here back to, let's call this the terminus. let's call this the terminus. Price experience decrease in value. The Nasdaq mini experience decrease in value from the starting point here at 20,790 to the terminus here at 20,012. So price experience decrease in value. This is a typical example of a downtrend. So if we are not going by that, the next point of call would have be where's the consolidation area, where's the expansion. If we are picking a consolidation and then an expansion upwards, this range is actually a consolidation area. You see that price didn't really show more direction. They went up, they came down, went up a bit more, came down way more. Price was just bouncing within this range. This is a classical example of a consolidation event. And if this is not too clear, you can look at it from this point. Price engineered liquidity here and liquidity here. And from what I told you about expansion, they can just take a particular direction. After the engineer sell side liquidity here, buy side liquidity here, and then price expanded outwards, upwards, to start another trend. This is the expansion leg. Look at the displacement, look at the displacement out of that range. The displacement out of that range, slight retracement, more displacement out, more retracement, more expansion upwards. So this is a typical example of a consolidation event, and with that, this is a typical example of an expansion event. They expanded out, retraced. This is the first leg of expansion, slight retracement with this particular down close candle, red candle, down close candle, retracement, more expansion up, retracement, more expansion up, retracement, then bigger expansion up, retracement. Then from there, more expansion upwards, another retracement, then more expansion, like that. So this is a classical example of consolidation, then expansion, then retracement, then more expansion, then retracement, more expansion and retracement. This is a classical example of it. And with that being the case, let's go to a case where price consolidated, expanded, then gave up the ghost. If you look at this particular price move, starting from this point, you see that price consolidated within this range. After climbing all the way here, price was bouncing. We were given these levels, form sell side liquidity, form buy side. Now they expanded outwards to take out the buy side, and then after taking out the buy side, they fell and reversed. They fell and reversed to take out this whole expansion move. They fell and reversed. This is a classical example of a consolidation, then an expansion outward, then a reversal. Velocity. This is velocity, and then this. This is a classical example of that. And if you look at it from another angle, that is why price is fractal, and a particular price action ongoing will be like a reference point for the future ones. Look at this particular price point. This particular price point where price was just bouncing and bouncing. They made this high, came all the way down, came like this, took out the high, and then after this, price expanded to downside, to the sell side. Price expanded to the sell side with velocity. and then they reversed it and reversed to the upside. This is another classical example of consolidation, expansion, then reversal. This is another classical example. And one thing I didn't tell you about retracement is, if we have, for every, let's say we have a consolidation move, something around this nature, and then we have price expanding upwards, a true retracement would be a retracement where price retraces at least 50% of the expansion move before going for another expansion leg. A true retracement would be a retracement of at least 50% of the expansion leg. So if this is the expansion leg, if it is the, I'm going to use a fib where I just calibrated 0. It's just like I use it more as a ruler just to find half range. So from here to here, from this high to this low is the expansion leg. And the retracement, you see that at least it went lower than 50%. The true retracement is something of at least 50% before the next expansion leg. Sometimes it doesn't occur that way, and they'll be right. Sometimes it might not even get up to 50%, it can be like this. But a true retracement is something of this nature. This is something that I anticipate for more in most of my trade. Something of, okay, if price expands upward, then I want to see a retracement down at least 50% or even lower than that before more expansion. So that's like a gimmick that I'm telling you. So this is just typical examples of it, about price moves. And price does this day in, day out. These are our charts. Day in, day out. Price does this. Price will consolidate, price will expand, price will retrace, and price will reverse. That is everything that the market does. Everything that the market does. Consolidation, expansion, retracement, and then reversals. Those are the things the market does. They don't have to do it at that sequence. They can consolidate, then expand, then reverse. They can consolidate, then expand, then retrace, then expand more, then reverse. So it can also be that way. But it doesn't have to follow that sequence of CERR, consolidation, expansion, retracement, reversal. No. But just know that this is how the market operates. This is what price move do. And that's the way price move. So till next time, folks, have a lovely day. Thank you.